Hello, I'm Peter Towers, Managing Director of ESS BIZTOOLS and Towers Business Development. Today, we're talking to you about corporate governance issues, in particular, the role of a director in a small and medium-sized business. If you have any questions during the webinar, can you please type your question into your computer? And if you're watching by our live feed on Facebook, or you're watching this video at another time, a time more suitable for you, can you send me a email if you have any questions, please? peter@towersbusiness.com.au. So I'm now just going to share the screens. So we should now be looking at the role of a director in small and medium business. In the first instance, it's a good idea when you're communicating with anyone about your role as a director that you introduce yourself, you give an overview of what your company's activities are all about, what you do in your business, what your position is, and that you are prepared to be able to deliver an elevator pitch to anyone who you are dealing with, so that they've got a very good idea of who you are and what you do within your business. The key components of an elevator pitch are what is summarized on the screen there now. You need to be able to state your business's products and the type of category that your business fits into. Describe the problems that you are going to solve. Focus on your proposed solution and state the key benefits of your proposed solution, but with a strong emphasis on what's in it for the person you're talking to. What's in it for them? Directors need to be aware, and it's a statement that I heard many years ago when I first became a director of a company, and I think we all need to bear that in mind, that issues can change and you need to be familiar with the law as it applies to companies, and to have a clear understanding of the duties of a director, your responsibilities, your powers. So some of the key issues that directors need to be aware of in Australia. Fair Work Australia rules are very important. You need to be monitoring what's happening there. The environmental laws, state and territory government laws, local government laws, councils, their bylaws can affect what's happening within a company that you might be a director of. Social media and media also come into your awareness of what's happening in those particular places. And if your company is sourcing products overseas, you need to make sure that it's been legally sourced. There hasn't been child labor, exploited child labor utilized in the production, because those things these days are illegal under the United Nations Convention, and your company can suffer high criticism through social media and other things. But what's of high importance for a company director? You need to understand the Corporations Act, particularly the sections relating to a director of a SME company. The Taxation Act is obviously very important. We're all governed by it. How does it work? Make sure that you have familiarized yourself with the general principles and approach within the Taxation Act. And bear in mind that with taxation comes the Fringe Benefit Tax Act, GST, and a whole range of other associated activities. Workplace health and safety codes need to be familiar to directors, and in particular, directors need to be making sure that they are raising questions to the leadership team very regularly, monthly, to make sure that the rules and regulations that the company has implemented relative to workplace health and safety are being enforced. And if there's any issues with that, that the board makes a decision and brings in an external advisor to make sure these things are fixed, because the responsible person under this type of legislation can very often be a director. You need to make sure that you're not going to get caught up in these types of things. Crowdsource funding equity raising. This is an important issue if your company has elected to raise capital utilising crowdsource funding equity raising, which was created by making amendments to the Corporations Act. The company needs to have a group annual international turnover of less than $25 million. It needs to have group value of assets situated anywhere in the world less than $25 million. It cannot be listed on a stock exchange anywhere in the world. And it must have 2 directors, and both of those persons must live in Australia, because the legislation says a majority must reside in Australia. So if you only got 2, well, they've both got to be in Australia. You need to have gone through a crowdsource funding intermediary, which is an organisation that's been licensed by the Australian Security Investment Commission, and they're the entity that assists the company to raise capital. So if your company is considering raising capital using crowdsource funding equity raising, you need to be able to familiarise yourself with the operations of that legislation. And we can do that for you at ESS BIZTOOLS to give you a great overview of that legislation, which is able to assist companies that meet those guidelines to raise up to $5 million in a 12-month period. Early stage innovation companies is the partner, if you like, to crowdsource funding equity raising. It applies to young companies, normally under 3 years of age, that have got turnover of less than $200,000 in the last 12 months, not including any grant income under the Accelerating Commercialisation Grant, and has expenditure of under $1 million. The general aim is that those eligible companies would have been undertaking work to develop a new product, process, service, marketing, or organisational methodology that they wish to commercialise. By being accepted as being an early stage innovation company, the company can raise capital, but the prime emphasis in the legislation, which was amendments to the Tax Act, was to give taxation benefits to the investors. So the investors can obtain an income tax rebate, and they can also potentially avoid having to pay capital gains tax on those shares when they sell them. So it's necessary for directors of a company that's aspiring to raise capital as an early stage innovation company to have a good knowledge of how that legislation works and how the due diligence process works, because the company needs to be approved by the Australian Taxation Office. And investors will want to see that the company has appropriately self-assessed if the directors are claiming that the company complies under the gateway test, which is black letter law. You either comply or you don't to the various requirements, or if the company is applying under the principles test, that the company has actually submitted its due diligence report to the tax office and Oz Industry, who will then assess whether they agree and will issue an appropriate letter that the directors can supply copies of that letter to potential investors. So the investors can see that if they invest in this company, they will be eligible to receive the incentives that the government included in that legislation amendments to encourage investors to invest in young Australian companies. The last capital raising that's available for SMEs companies, other than doing an initial public offer to go onto the stock exchange, is Section 708 of the Corporations Act. Now, generally, the Corporations Act prohibits advertising or solicitation of investors and requires a prospectus to be issued if a company wants to raise capital. In this case, if you're raising capital under Section 708, you don't have to issue a prospectus, but you can only raise a maximum of $2 million from 20 investors in a 12-month period. So there are some rules that also apply to there that I'd suggest that directors need to be aware of. The rules and regulations relating to COVID-19 lockdowns are important for directors to have a good working knowledge of. And the other big area is court cases create law. That's the whole basis of common law, which goes back over 1,000 years, that the countries which adopted the British legal system as the basis of its own legal system for individual countries, which obviously Australia did, and every state in Australia did. We need to be aware that judgments made by courts can create law. And this can mean that some aspect of the company's operation that you have under your control or your directorship may be influenced by a decision that's been made in a court somewhere in Australia, and some cases overseas, but mainly obviously in Australia. Appointment of new directors is a key issue for a director to consider. First of all, I think it's a good idea to look at the skills needed on the board. You really don't want a board that's got 3 or 4 members that are all accountants. And you don't want a board that's all lawyers or all boilermakers or whatever. It's a good idea to have a mix of skills and knowledge and background and contacts by having one, but no more than 2 of the same profession or industry type background, because it gives your board then the best opportunity of being able to have knowledge around the board table on a particular subject, and also being able to communicate with other people that you need to contact with. When we talk to company directors, we look at the director's skills matrix. We have a chart which helps identify the skills of individual directors, because the board should have identified what skills are needed. Let's see if they're going to be filled. Directors need to continue training. It's not an appointment for life, and it's not a skill development. You've done it once and you know it forever. You need to continue to keep up your reading, attending courses, attending webinars such as this. And I think one of the, pardon me, the key roles for the company chair is to be mentoring directors, especially young or new directors, in their role, so that they have got a strong feedback as to their performance, the type of questions they're asking, the impression they're given as to whether they're turning up charged up, ready to sit down and concentrate on this company's problems, or are they walking into the meeting opening their board papers, or just for the first time reading the emails that have been sent to them. or openly admitting that they haven't read something. That's not preparation for a board meeting. Directors should be turning up with their brain in gear, ready to discuss and debate. I was the secretary of a listed public company some years ago, and it was interesting to see how professional directors operated. Not all were prepared, I must admit, but the chair of our company made sure some of those people went somewhere else. So it's very important that directors are on top of things. A new director also needs to understand the company's constitution and ask for a copy of it and read it. And if they've got questions, talk to the chair about it or the company secretary. The rules as to how often a general meeting of the company can be convened need to be understood. In many cases, directors can fill a casual vacancy, but some constitutions might say that a general meeting of the company's got to be convened to fill a casual vacancy. New directors need to sign an acceptance of appointment letter. Very important. The law requires the directors to sign an acceptance of appointment letter. And that appointment needs to be recorded by the company secretary or some other person delegated for that role into the company directors register. And notification of the appointment needs to be lodged with the Australian Security Investment Commission within 28 days of the appointment. And that means then that if someone searches the register, they find out who the company directors are and know the date that they were appointed. Now, it's an honour to be asked to join a board of directors. There's no doubt about it. But I also think, though, you have to be careful. You have to be aware, to use the terminology I used at the beginning of this discussion. So before an appointment is ratified, I think a new director should be asking some questions about the company's solvency. And the key ways of doing that is to find out, is there outstanding liabilities to the Australian Taxation Office? Superannuation for loans, how much are they? What effect is this likely to have on the company's ongoing operations? We have a new directors questionnaire which we supply to our clients so that the new director can actually sit down and work through a checklist of information that he or she should be looking at so that they make sure that everything is as it is stated. Let's look at the responsibilities of directors. They're very onerous. One of the key jobs is to appoint a managing director or CEO, someone who's got the day-to-day responsibility of running the business. And there's a requirement to be looking at monitoring systems. Is there a process in this company for asset acquisition? Is there a process for intellectual property development? And has it been documented to decide whether it's going to be worth money? And can it be commercialized to earn additional income for the company? Are appropriate accounting systems set up to record debtors and the inventory, the amounts the company owes, the creditors, the bank accounts? And who's looking after workplace health and safety requirements? Making sure the team have been trained in how they conduct themselves in their day-to-day activities so they won't be hurt. Now, directors are not normally responsible for actually attending to this work on a direct basis, but they need to make sure someone is within the leadership team. And this monitoring of systems also goes on to things like the human resources or Fair Work Australia requirements. Who's looking at that? Who's monitoring it? Risk management. What are the key risks affecting this company? And we've all learned a lot about risks in the last 18 months, haven't we? How many of companies around Australia really had a major virus like coronavirus listed in their risks? Some did, but a lot wouldn't have. What equipment risks are there? Cash flow management, that's the management of debtors, stock, cash position at the bank. Environmental issues. There was hardly ever anything ever said about environmental issues 30 years ago, but now it's a very high priority, and we need to be conscious of it and check that the company is abiding by the regulations. And your responsibilities as a director is to ensure that that is being done. Directors need to know that the financial systems are appropriately being administered. The financing arrangements, the payment of taxation, payment of superannuation, communications with customers and how customers are paying. It's all important because the directors are responsible for these matters. How are shareholders communicated with? Is there a stated process that the board's going to communicate every 3 months, say, or every 6 months? There are some legal obligations under the Corporations Act, or they might be documented in the company's constitution, or the chair of the company has indicated to the shareholders that the board will be communicating on a regular basis, and whatever that regular basis is, the directors should be making sure that this occurs. And there could be requirements for stakeholder contribution depending on who the stakeholders in your company are. It could be a government department that you're doing a lot of work for and you've agreed to keep them informed of developments within your company. There could be another corporate entity, or there could be a local government organisation. It's very important that directors understand what these commitments are and then ask questions to make sure that those commitments are being fulfilled. Culture is an interesting question. You won't find the word culture in the Corporations Act, but it's very important when it comes to how a company can operate. Is it a friendly culture? Is it an open culture? New team members welcomed? Are they inducted in an appropriate manner? Are they shown how the business operates, or are they just thrown into the deep water to see whether they can swim to the other side? What about the customers? Do they feel as if they're the top priority within this particular company, or are they barely tolerated? Culture is very important. It's very difficult to really put your finger on it, but you can feel it fairly quickly when you're dealing with an organisation that might not have a high-class level of culture within that organisation. Directors should be making sure that the company has a business plan that is updated each year and should be having an input into the development of that business plan. Whilst primarily it's the responsibility of the leadership team to develop it, directors are running the company. So the directors, I think, should be having sessions with the leadership team to make sure that their views are written down and developed within the overall fabric of the business plan. Because the business plan is clearly stating what the company is going to deliver over the next period of time. Capital raising. Now, this gets back to directors being very conscious of what the future projections are showing. Where's this company headed? Is it aspiring to scale up and grow? Is it currently on a turnover of $3 million? But the business plan has indicated that the directors and leadership team are aspiring to a turnover of $7 or $8 million in 3 years. If so, where is the funding for that growth going to come from? Because directors should be analysing what's going to be involved in that growth. Is it going to increase the debtors ledger substantially? What's it going to do with creditors? Is that going to expand? which would help the funding of the extra debtors. But in a lot of cases, the suppliers to the company might be saying, no, you've got to pay us strictly on 30-day basis. And whilst the company might try to achieve those sort of payment terms from debtors, it doesn't always work. And in most cases, it doesn't. And the debtors will take longer, 40, 50, 60 days. What's the impact on the cash flow within the business of that sort of trading terms? What about inventory? The company currently might have an inventory of $150,000, but as it wants to expand to a $7 or $8 million turnover, what will the inventory grow to? We're going to end up $400,000. So that's an extra $250,000 in that investment. Now, some of it might be in creditors, but depending on the terms and conditions from the creditors. The company might be involved in a significant research and development activity that's now been agreed to by the board, spending $250,000, $500,000 a year on research and development, trying to develop new products or services that the company could then commercially exploit in the marketplace. But this is also requiring money to undertake that research and development. So directors need to be thinking and having discussions, well, where's the company going to get this money from to grow? Should the company be looking at its opportunity to raise capital? If the company's been going for a while and the one I just mentioned is beyond any assistance coming from the early stage innovation company, but you could look at raising capital under Section 708 if you can go out and approach some people without having to advertise, market it or promote it. But you can only go to 20, and you need to be very much aware of how many shareholders the company already has, because a private company has got a limit of 50 shareholders. But these days, and thanks to the federal government 4 or 5 years ago when they introduced crowdsourced funding equity raising, the company could go to the market to raise up to $5 million from as many shareholders as you require. Could be 1,000, could be 2,000. Doesn't matter. The legislation doesn't impose a upper limit. And those shareholders can come into the company and go on a separate register, crowdsourced funding equity raising. Now, there's a whole process for that. And if the board is seriously looking at funding issues and contemplating crowdsourced funding equity raising, it's best to start planning as soon as you can. And you can talk to me about that if you like, and we could work out how that's going to fit into your overall game plan going forward as to how all this is going to fit together and who's going to prepare the various information that's required. Let's have a look at the liabilities of directors, because this is very important. And top of the list is insolvent trading. Directors need to make sure there's enough money going to be flowing through the business in the normal course of events to pay the liabilities that the company is incurring. And that means paying those liabilities in the normal course of events. And that's basically within the supplier's payment terms that have been specified to the company. Obviously, making Australian Taxation Office payments, and if they're not paid, directors can become personally liable. That's why you need to check out before you're appointed to a board of directors what's currently owing to the ATO, because that can become a personal issue for a new director. Doesn't matter that you weren't there when these debts were incurred. You accept appointments to a board, you are then one of the persons that's liable for that amount to be paid. You need to make sure there are appropriate systems to protect employees and contractors and other people that are on a job site that your company's involved with, or in your workshop or office or storage facilities. Doesn't matter where. You have got a key responsibility to protect people. Environmental issues I mentioned before, they can become a huge problem, and under some of the environmental acts around Australia, directors can be sued. Fair Work Australia, there are all sorts of regulations within that legislation also. And many of them can come back and affect directors. Workers' compensation. It's illegal for a business to be operating without workers' compensation cover. And if you're a director of a company that hasn't obtained a workers' compensation policy, you can be in real trouble, especially if in the unfortunate event an employee is killed or very seriously injured. There is very serious consequences for that. There's liabilities summarised within the Corporations Act, and there is some state legislation, obviously around Australia, state and territory, for specific industries. And one of your key liabilities, and as part of the concept of corporate governance, is that a director declares their interests in any matter being discussed by the board. Now, some boards try to sort this out when a person's appointed or at the first meeting each year to say, can you submit an update of your personal interests? We see this with the politicians. It's amazing how many of them forget that they own 20% of this or 30% of that. But it's what the company decides should be declared. Other times you would declare your interest in a matter being discussed by the board, and normal corporate practice is that you would then leave the room while the meeting proceeds to make a decision on an interest that you've declared that you have an interest. Doesn't always happen, the director leaves the room, but I think it's good corporate practice. Perhaps you should discuss it with your co-directors and agree on a policy. It's part of the decorum of how your company is going to operate. It's part of the culture. If there's conflict of interest, the directors leave the room. We might just have a look at the managing directors. What's their, who appoints them, responsibilities, duties? Well, the first thing to do in a lot of these instances is check your company's constitution. And I'm always surprised at the number of people who I talk to who have been directors for 20 years and never read a constitution. Please read yours, mark it. If you don't understand it, talk to your accountant or your solicitor or the company secretary and find out what things might mean and how they apply. Managing directors should be reporting back to the board of directors meetings. I think they should be in attendance and they should be reporting directly. There might be some specific responsibilities that have been handed to the managing director because the board has asked the managing director to specifically follow this issue through and sort it out. And I think it's important in the initial engagement of someone who might be called a managing director or a chief executive officer or a general manager, who they report to. And this can be a big issue in charities and not-for-profits, because at times you find that the CEO or general manager seems to think that they don't answer to anyone. They answer to the members. Well, answering to the members is great, but all these organisations have board of directors or management committees, and that's who the person should be reporting to. And normally that is nominated, not always, but normally as being the chair of the board or the committee that the CEO is responsible to. And that means that they communicate daily if need be, normally weekly. The managing director, though, is the person that would normally be responsible for any appointments in the organisation. Now, some of them he or she may delegate to other members of the leadership team, but I think it's dangerous for a board of directors to be appointing a salesman here or an accountant there or a office worker somewhere else. That should be the responsibility of the managing director, CEO, whatever other title you want to give that person. And the managing director should be establishing the management or leadership team, not with any involvement of the board. Normally they do it themselves. because after all, this person is going to be facing each board meeting and giving a report and copying the criticism if something's gone wrong. It's important that the managing director allocates portfolio responsibilities, but the real importance for a director is to make sure that someone's been allocated these portfolio responsibilities. I don't like seeing a list of who's handling what duties within a company and seeing everything's been allocated to one person. It's normally the CEO. In some cases, they want it because they're going to accumulate all that power. That's not good. And from a director's point of view, you should be raising that as a serious issue. You need to spread these jobs out so that the team are doing a variety of work, and you've got a variety of people with that very important responsibility. And these people are responsible for operating the business. So the CEO or managing director needs to appoint people and tell them their feedback requirements so that they are in control of the current business activities, the operations, the financial position of each of those, so it can be summarized and submitted as a report to the board of directors each month. Board of directors operate with a company secretary. The company secretary can be a director, but it also could be an external person, or it could be one of the team members. Normally, the company secretary prepares the agenda for a directors meeting and submits it to the chair, or we might have a cup of coffee with the chair prior to and drafting it together. But it's important that the company secretary recognises that the chair is the boss. There should always be a follow-up of business arising from the previous meeting so that there can be an end date allocated to every issue that comes in front of a board of directors. Otherwise, it's still in the pending column. And company secretary should be working hard with the chair to clear things up, to get a report back, to get a decision made, put it into an action plan so that it gets allocated to someone to implement. And I'll talk about action plans again in a minute. They're a very important device. So the company secretary should be responsible for confirming the date of the next meeting, the time and the place. I think it's a good idea to implement within the company the culture that board reports are going to be distributed to directors within 72 hours of the meeting, because this enables a director to read the material first, to think about it, to get their brain in action when they walk into the meeting, because they know what the key matters to be discussed are. They've been forewarned, because you want them ready to make contributions. The secretary should also prepare the minutes of the meeting and the action plan. And the action plan basically is summarising what the decision of the board was and identifying who's going to look after it, who's going to follow it through. And the minutes in the action plan should be submitted to the chair for approval before they're distributed to the directors. Let's have a look at the director's personal responsibilities that you need to be thinking about. I'm just going to check first of all to see if I've got any questions. I got no questions. If you think of any questions, please let me know or send me an email. Directors need to keep themselves informed. What's going on? What's happening in this industry? So read reports before meetings, not at the meeting. But most importantly, at meetings, ask questions, especially if you don't understand something, because your whole career might be on the line through you not asking some questions and getting clarification of what's happening. If you don't understand, get the board to approve some legal or expert opinion being made available to you so that you can understand what a particular issue is all about. You must declare your interests, that we discussed a little bit earlier. But it's important to respect confidentiality. Matters should be freely discussed in the board meeting, but then stay in the board meeting. It's also very important that you read your minutes very carefully. You just don't accept them. If you don't agree, raise it immediately with the chair and then at the next meeting. Make sure the minutes are changed or consider your position. If you believe that a decision was made one way and it hasn't been recorded that way, and the other directors don't agree and the chair doesn't agree and obviously the company secretary doesn't agree, well, do you really want to be on that board? Because sooner or later, that could come back to cause you very big problems. If you're unable to perform your duties, you should resign. If you cannot attend the board meetings because the law says you are a director. Just because you're busy in your other activities and don't attend board meetings doesn't mean that the law treats you with leniency. It doesn't. The law really says if you can't do your job, get out. Let someone else do it. One very important issue that I think directors should be looking at is the concept of quality time. Time to think. A bit hard in this modern world, isn't it? Planning the future. Thinking about where everything's going. Not working on the tools all the time. It's a real problem for all of us. But directors or people running businesses have got to sit back every so often and allocate some time. No telephones, no interruptions. And just think and write down notes. Perhaps watch some videos, watch some recordings. But think about the future without worrying about the daily activities. And I think it's a good idea that you should be encouraging the setting of strategic goals within the business. What do you want to achieve? What do you think the company could achieve? So that's an overview of some of the key matters as I see them that you might look at within your company to be able to perform your role as a company director and to also ensure that you're not going to be having problems with other people, Australian Security Investment Commission and others as to what is happening or what has happened within the company. If you have any questions on any particular activity, I'd really invite you to contact me. We can have a look at it. Towers Business Development offers ongoing training in these corporate governance issues. We dig down a lot deeper than what we've done in an overview webinar like we've done today. We can also assist with performing the company secretary duties for companies and assist in the preparation of reports and agendas, minutes, and the action plans that come out of board meetings. We're running a weekly series on these issues of SME companies in operation, financially, corporate governance, capital raising, research and development issues, which is going through until the end of August. Our next webinar is identifying grants for businesses. This might be a real interest to you, which is on Wednesday, the 11th of August at 12 noon. The next one on the 18th of August, also a Wednesday, is business review meetings. What do we mean by business review meetings? How do you get them to work so that they're effective in helping the company's operations and your team? And planning funding for your business. We're going to look at Section 708, accelerating commercialization and crowdsource funding. How do they all fit together? How do you develop a roadmap to be able to utilize these capital raising opportunities. You know, it's only the last 4 years that we've had early stage innovation company and crowdsource funding. Before then, we had Section 35. And prior to that, there was nothing. It was very difficult to raise money unless you were dealing with your family or someone you'd played golf with for 25 years and all sorts of things like that. So we've got the opportunity to utilize these new ways of raising money that needs to be undertaken in a very responsible manner. And it's, I think, a requirement for company directors to have real good knowledge of how this all works so that you can look at maximizing this opportunity for your company. If you're interested in attending any of these webinars, which are free, please go to our website, www.towersbusiness.com.au, and click on webinars. So thank you very much for joining us today. I hope that you're safe wherever you are around Australia, particularly, of course, if you're in one of the lockdown areas. Hopefully this whole problem of COVID-19 is going to be sorted out in the not too distant future. Unfortunately, it looks like it's going to carry on for a while yet, but it is making business activities very difficult. If there's any activity that you think that I and my team at Towers Business Development can help you with, please contact us. Send me an email, peter@towersbusiness.com.au, or go to our website, www.towersbusiness.com.au, or telephone me on 1800-232-088. Thank you for being with us today. Have a great day. Goodbye.